Hello and welcome to the Smart Value Bites. I'm Soumitra Sengupta. Today in this video, we are going to talk about the importance of cutting your losses. Um, Ed Seykota, a legendary trader and a Wall Street icon, once said that the three most important rules of trading are cutting your losses, cutting your losses, and cutting your losses. In other words, if you have a stop loss in place and are able to execute it, then maybe you can become successful as a trader and an investor. So said Ed Seykota. So how does one cut losses? This is done through a stop loss order. A stop loss order is an order used by trader or investor with instructions to close out a position by buying or selling a security at the market when it reaches a particular price known as the stop price. A stop loss order of this type is used to limit losses or lock in profit. So how does one cut the losses? This is done through a stop loss order. The stop loss order is an order used by the trader or investor with instructions to close out a position by buying or selling a securities at the market when a particular price is reached, which is known as the stop price. A stop loss order of this type is used to limit losses or lock in profits on an existing position. Traders and investors can control their exposure to risk by placing a stop loss order. There are two issues relating to stop losses that are crucial. Ignoring them can prove to be very damaging and may even be tantamount to not having a stop loss at all. The first and most important thing about a stop loss is that it should be determined before the trade or the investment is initiated. This is very important. Deciding your stop loss is not something that you can do as you go along. The reason that you should determine your stop loss before the initiation of the trade is because it has to be part of your overall trade plan and can be decided objectively. Once you're in the trade, you are invested and you have an emotional commitment that will hinder your ability to mark your stop losses judicially. Then there is the matter of executing a stop loss. Very often traders are not able to execute a stop loss at the predetermined price, particularly if it is going to result in a loss. If that happens, then the whole process of determining and setting up the stop loss gets negated. The second and equally important part of setting up stop losses is to determine what the stop loss is and at which price does it become actionable. Simple omnibus rules like a 5% stop loss or a 10% stop loss are not very effective, though they may be used as part of the trader's overall money management strategy. The most important consideration in setting up a stop loss or figuring out where your stop should be is the volatility of the securities. Different securities have different volatility profiles. So-called blue chip stocks have lower volatility, and so the stop losses can be put in tighter. Small cap stocks, which have a higher volatility, should have wider stop losses, as very tight stop losses can get hit prematurely. A good indicator for determining stop losses and where to put it is to understand the dispersion of the stock's prices. It's called a mean variance analysis, and it is up to the judgment of the trader or the investor where the mean variance continuum he will put the stop loss. It could be one standard deviation away or two standard deviations away or even further, depending on his risk tolerance. Many traders and investors do not realize that all trades they make will not be profitable. In fact, you're very good if 50% of your trades are profitable. If you realize this and enter the market with this understanding, as do professionals, then you will quickly weed out your losses and let the profitable trades remain. All aspects of the market are asymmetrical, and you need to align yourself with this asymmetry. Using stop losses helps you to do that, as it takes it takes you out of your losing trades and not disturbing your profitable trades, because that will be beneficial as it keeps you in the stocks that are giving you the most returns. Let me dwell a little bit on the asymmetry of the markets. In the financial year 24-25 that just passed and ended on March 31st, if you add up the returns of the 50 stocks in the Nifty 50 index, the total comes to 188%. This return, however, this return is principally from four stocks: Bharat Electronics, Bharti Airtel, Shriram Finance, and Mahindra and Mahindra. In contrast to these returns, the overall Nifty return was only 5%. And these 5%, this entire Nifty returns came from these four stocks. That's how asymmetrical markets are. And a trader has to be aware of this asymmetry and be very, very careful to be with only the profit stocks that are profitable, because most of the time, most of the stocks are doing nothing. And if you get stuck in any of those stocks, then your portfolio is not going to go anywhere.